Investors aren't exactly happy with the market's current circumstances. Major indices have been low in previous years and interest rates are rising. However, Warren Buffett, one of the world's most notable investors, is unfazed by this as he has had a solid strategy that always gets him through an economic crisis. Hello and welcome to Eminent Investments. Today we'll look at Warren Buffett's ultimate investment strategy for 2023. Before we start, give us a like and subscribe to the channel. If you're done with that, then let's get right into it. Lately, the Federal Reserve has been relentlessly making financial conditions restrictive. This has been the case despite facing the repercussions of the Silicon Valley Bank collapse and the recent changes in regional banks. Sadly, this economic situation is the reality of most investors and they're forced to face it head-on. Future forecasts don't look too well either as elevated rates are being implemented by the Federal Reserve. You might be wondering, what are the consequences of these increased interest rates? Other than the decrease in inflation, which is the cause of the initial interest rate hike, there are way bigger effects that increased rates inflict upon the economy. 1. Heightened cost of borrowing, and 2. Decreased consumer spending. These circumstances yield 3 implications. 1. It can make bond prices cheaper, making them seem more attractive to investors. 2. It can cause an increase in savings, incentivizing people to save. And 3. It makes people think twice about purchasing stocks as it sounds like a risky investment. In this scenario, how do 2023 investors navigate through the risks and gain bigger returns? The Oracle of Oklahoma, Warren Buffett, follows a 3-step algorithm for selecting stocks. Select companies that hold competitive advantages, or moats. He also adds that we must gain a deep understanding of how they operate. Make heavy purchases at a rational price. However, you should only take the risk if it has strong economic fundamentals. Make long-term investments. As you can see, Buffett doesn't complicate himself with his investment strategies. However, outside those 3 steps, he stresses the importance of temperament. He believes that Berkshire Hathaway's success is rooted in the fact that they're sane amid the pressure, and not because they make smart choices. In a letter that Buffett wrote for Berkshire Hathaway investors back in 1996, he stated that they shouldn't own any stocks if trouble in the market causes them to panic and sell. In that same letter, he also wrote that deciding to sell solid businesses due to distressing news usually ends in bad situations. To support his statement, he mentioned Robert Woodruff, the brilliant mind who cultivated the success of Coca-Cola. When asked about the perfect time to sell Coke stocks, he simply answered, "I don't know, I never sold any." However, despite buying the right stocks with the best strategy, you can still lose everything if you have the wrong temperament. Furthermore, Buffett also discusses the 3 philosophical benchmarks that he uses as he deals with the market, which are your perspective on the market. This is written in Chapter 8 of The Intelligent Investor, which stresses the importance of having the right attitude in order to gain an advantage over other investors. Margin of safety. This gives every investor an edge, and it can even be applied beyond the world of investment. Perceiving stocks as businesses. Having this viewpoint makes you different from typical investors, and it gives you a better understanding of how the market works. If one follows those 3 philosophical benchmarks, it doesn't matter what evaluation technique you use. Whether you follow the ways of Fisher, Walter, or whoever, you're secured on a solid path. The aforementioned benchmarks serve as a guiding framework that aids investors in staying focused, and it's compatible with any evaluation method that you prefer. However, if you're the type who doesn't have the patience to navigate the market's unpredictability, Warren Buffett advises you to get into passive investments. The most basic one that he prefers is investing in index funds, and with this, you must only have one mindset, which is to believe that America and its businesses will sustain its success over the long term. Back in 1942, he bought his very first stock, and after he did that, a lot of crazy things happened to the economy. However, he ignored all the biggest headlines and market fluctuations and solely focused on his belief that America would prevail. This approach makes investing easier, especially with index funds, as you don't need to stress yourself with selecting the right stocks, timing when to buy or sell, or even knowing that the FED exists. In his 1996 letter to the investors of Berkshire Hathaway, Warren Buffett strongly believes that for most investors, the most effective way to own common stocks is by investing in an index fund with affordable fees. He is convinced that people who adhere to this strategy are most likely to outperform the overall outcomes obtained by the vast majority of investors. However, how strongly does he believe in index funds? He seems to have a lot of faith in it, as he advocated it to the famous NBA star LeBron James, advising him to make monthly investments with low costs, such as an index fund. According to Buffett, investing in index funds is close to owning a piece of America in the long run. In connection with that, Buffett has a critical stance against the hedge fund industry. Despite their long list of bad performances, hedge funds impose huge fees. It doesn't come as a surprise to Buffett that low-fee index funds generate more returns through time, as opposed to an actual portfolio that a hedge fund manager handles. Back in 2008, Warren Buffett presented a challenge, and he asserted that in 10 years, an S&P 500 index fund would perform better than a hand-picked portfolio by hedge funds. This wager cost $1 million and it was accepted by Protégé Partners LLC. By the end of 2016, the S&P 500 index fund betted on by Buffett had garnered an annual gain of 7.1%, equating to $854,000 in total. On the other hand, Protégé's portfolio only garnered 2.2% annually, equating to $220,000 in total returns. The fund Buffett selected was the Vanguard S&P 500 Admiral Fund, while the hedge fund preferred not to disclose its portfolio. This wager only proves the legitimacy of Buffett's claims. Indeed, an index fund generates bigger returns than hedge funds. By always applying this technique with the use of dollar cost averaging, investors can gain astonishing outcomes. Pair that with saving and investing and you will see stocks at varying prices over time, reducing the risk linked with trying to time the market. Moreover, Buffett has another piece of advice, which is to evaluate companies that are within your circle of competence. You don't necessarily have to learn everything about investing. What matters is that you know the limits of your knowledge. There is no need to memorize formulas and theories, but you do need to know two things: knowing a company's value and your reaction toward the market. He emphasizes that every investor's goal must revolve around purchasing parts of a business that one understands. It must also be at a rational cost that can pay itself off at a much higher rate in the future. If you do find the stock that fits the bill, Buffett recommends you buy a meaningful amount of it, but you must stay focused on keeping it for the long term. This approach resulted in impressive gains for Berkshire Hathaway shareholders. Their combined earnings have seen staggering growth, equating to a big increase in the company's stock value. For consecutive years, Berkshire stayed true to this approach, allowing them to bolster earnings from their present ventures and buy more companies with significant competitive advantages. In fact, from 1965 up to the present date, Buffett's investment portfolio has yielded a compounded annual growth rate of 19.8%, which is almost twice the S&P 500's growth rate of 9.9%. Moreover, his portfolio has a total gain of 3.7 million% compared to the S&P 500's 24,708%. Now let's go back to the present economic conditions and what lies beyond that. One obvious aspect is high inflation, which has caused an increase in interest rates and delayed economic growth. This seems like a tough time, but previous rallies prove that this too will pass, just like every other economic crisis. However, when times are rough, you can still invest, and Buffett has a few strategies that you can abide by. View a stock as part of a business. This only means assessing the business before making the big purchase. With this, you should select stocks that can withstand the pressures of inflation. But how does one identify those types of companies? Based on Buffett's 1981 letter to Berkshire shareholders, the company must have the ability to easily increase prices. Examples of these are Apple and Coca-Cola, big companies that are able to maintain market share without fear of losses. Capacity to handle large dollar volume increases. A company must be able to generate intensified revenue with relatively minimal additional capital outlay. Take tech giants, for example, who are able to introduce new revenue-generating models at a low cost. Other than the profound knowledge that Buffett has already shared, he also says that investors should shift their focus to specific companies rather than the general market's performance. He also recommends investors invest in themselves, such as learning new skills and talents. Lastly, he recommends not buying gold during a time of inflation, believing it to be an asset with no productive capacity. It's basically relying on price appreciation without assurance of getting those returns. Well, that's about it for today's video. If you liked our content, do give us a like and subscribe to the channel. Once again, this is Eminent Investments. Thank you for watching and we'll see you next time.